Yeah, there we go. Go.
Okay, good afternoon. So my buy recommendation is going to be eBay. So my investment thesis, the first point is going to be improving gross margins in all of their business segments, as well as strong third quarter results. Second is strengthened payments. They operate PayPal, and they recently acquired Braintree Payments. And they also had a 2012 agreement with Discover Card. Third would be industry tailwinds. There's tremendous growth in the e-commerce as well as mobile platforms, payments space. Fourth is strong balance sheet and cash position. This enables further acquisition opportunity. And the fifth will be valuation. They're currently trading at a discount to peers. With my method, I estimate about a 36% upside for eBay. Moving on into business, they have an A rating for business. They're in the internet software and services industry. They're essentially a provider of online platforms, tools, and services, e-commerce, payments in the United States. Their business is driven just basically by the use of the internet, as well as the increasing use of mobile and online payments. They have three segments. Marketplaces is about 52% of their revenues. This is what we know as eBay.com. Second is payments. This is 40% of revenues. This is going to be PayPal as well as other smaller companies that they've acquired to expand their platform. And third is GSI, which is about 8% of revenues. This is essentially just a provider of e-commerce and interactive marketing services. So segment gross volumes, my first investment point. So marketplaces, active users was up 14% in 2012, as well as GMV was up 13%. Payments, registered accounts were up 17%. Payment volumes were up 24%. And GSI, gross merchandise volumes were up 13%. Management also has an A rating. Management has cited that they are going to continue their investments in customer experience and just basically product availability, improving their services. They instituted a seller recommendation policy and rating policy online, and just basically improving the customer experience. They also have a number of acquisitions in the past 3 years. Most notably, we'll focus on GSI, which is marketing services, as well as Braintree Payments in 2013, again, just expanding their online platform. Their balance sheet has a B+ rating, so they have ample cash. Their debt to equity is about 20%. They're beating the industry average for ROA, ROE, and ROI. Their 5-year growth is about 15%, and they're consistently converting more of their cash into investments. So now looking at this graph, you can see at the bottom this is showing relative strength. So the relative strength is less than 50 and it's trending downwards, indicating that it's moving towards oversold, which is an indication that this might be a good time to buy this company. Price and valuation has an A rating. So their PE ratio is about 24.8 right now. This is at a discount to some of their peers. Their price to earnings 5-year average is about a 17.8. PG ratio is 1.69, which is lower than the industry. And so using a price to earnings multiple valuation, their forward-year EPS estimate and the average price to earnings of competitors, I have a 36% upside. So the stock price is about 70.9. So their risk is going to be their debt, obviously. They do have a little bit of higher debt than the industry. They're also very dependent on access to the internet and mobile networks. They're subject to possible fees or restrictions, as well as an increasing competitive environment. You're seeing companies like Amazon and Google getting into the payment space, as well as just macroeconomic consumer spending and sentiment. We know it's fairly weak right now. Margin of safety is going to be their third quarter results that they just reported. They pretty much beat in all of their revenues for segments. As well, they maintain a large cash position. This is mostly to fund their acquisitions as well as pay off their debt. And their business is supported by strong industry trends and consumer trends. So moving on to sell. So my sell is Toll Brothers. My sell thesis first is going to be macroeconomic headwinds are not very supportive of their continued momentum. As well, their recent acquisition of Chappelle Industries, I believe, is not lucrative to their 2013 profits. They estimated to have overpaid for the deal. Third is their balance sheet is somewhat weak. They have a decelerating cash position and an increasing debt position. Fourth, I looked at some technical indicators. I looked at RSI as well as resistance levels, and these do not support further momentum. Fifth, would be estimated earnings deceleration into 2014 just due to this acquisition, as well as possible slowing demand in the housing market, absent of industry growth. So business description, they're in the home construction industry. They basically design and build luxury homes and communities. Their target market is going to be upper income second home buyers in the United States. Moving on to their business, so I gave it a C rating. This is mainly going to be an industry play. The U.S. housing market had a sharp improvement in 2012. We saw that. However, the recovery has slowed a little bit in 2013. You're not seeing the same growth rates. Prices continue to rise, but they do remain about 27% below peak levels in 2006. The industry has been boosted by record affordability levels. You're seeing most companies in this space, stock prices have skyrocketed in the past couple of months just due to what's going on in the economy, as well as other macroeconomic headwinds like unemployment remains high, lending standards remain tight. It's about 20% down payment for a house. It used to be over the past decade about 5%. As well as builder confidence decrease in October. The HMI index, you saw all three of their points decline in October. Management, I rate it as a C. It's estimated based on the purchase price as well as the total average sale price of a home to have paid about 22% above what they should have. They also issued new shares, and this is estimated to have about a 4% dilution to shareholder equity. As well as in their conference calls and just talking with analysts, they have not cited any catalyst for 2014. Their balance sheet has a C+ rating, so for the past 3 years they've had a decelerating cash position, about $826 million in 2012. Their long-term debt is at a 10-year high. It's about $2.25 billion compared to $1.49 billion in 2005. And past 3 years sales are at all-time lows. Their sales right now are about $1.8 billion in 2012 compared to $6 billion in 2006. So this is showing historical resistance levels. So you can see they're kind of hitting this resistance at 36, 37, and this is from the past year. So looking at what their stock price is right now, this leaves for minimal upside, if any, if they do even continue to grow. So this is the toll versus the S&P 500. So you can see that they are underperforming the market. Even though the market is doing fairly well right now, they have not been consistently moving with the market and have been fairly volatile. Their RSI is about 60 and it's trending upwards towards 70 levels and moving into the overbought region, which is an indication that it might be a good time to trim our ownings in Toll Brothers. You can kind of see the correlation here as the RSI moves up into these higher levels. The stock price tends to drop. Price and valuation has a B- rating. I believe that the industry itself is overvalued. The household durables industry is trading about 34 times compared to the S&P. ROI is about 8.6, which is less than other industries. Their price to earnings right now for Toll is about 12.4, and their forward price to earnings is 16 times. So using a price to earnings valuation method, considering their forward year 2014 EPS and their forward price to earnings, their stock price is about 25, which is 22% downside. So their risks obviously would be the continuation of Fed quantitative easing, maintaining low interest rates, like kind of what we just talked about, and this would obviously continue to spur spending and investment. This is good for home-time buyers. Obviously, if the housing market continues to rally, pent-up demand regardless of what the Fed does. They're also targeting to the luxury target market, so they're maybe less effective, and they're trading at a slight discount to their peers.
All right, questions?
Yeah.
So one of eBay's biggest competitors is Amazon,
Mhm.
and they've been doing very well. What distinguishes eBay from Amazon?
So that's actually a good question. Amazon is essentially like an online store, whereas eBay is a marketplace for buyers and sellers. So Amazon has stocks of products. They have to keep stocks of products. They have major warehouses that have costs, etc. eBay essentially is just a place for buyers to come and buy sellers, and it's like a match-up process. So although they are offering some of the similar products, it's not exactly the exact same business model. So I believe that that's kind of one of their differentiators is, there's not really another company out there that is doing that on such a large scale like eBay is. And Amazon, again, they have been doing fairly well, which just kind of shows that the online shopping experience and consumer trend towards that it's a positive for eBay as well.
Any other questions?
So, to transition back to Toll Brothers, you mentioned that one of the risks is a slowdown in U.S. housing market. Do you see that as being a short-term trend or a long-term trend?
I think right now I see that as a short-term trend. So again, in October, you saw a decline in the HMI index, which is the housing market index. Builder confidence was down. So that kind of was equated to people, the government shutdown, consumers kind of stalling a little bit, builders stalling. So I think overall it might be more short-term, but I don't really know that there's a way to kind of predict that out to the future. I think what we saw in 2012 was obviously like a huge run-up and a huge peak in that. I don't see it gradually. I don't really see it like increasing all that much after that. I think we're going to start to see eventually kind of a gradual stagnant slowdown.
Excellent, thank you. All right, next up. Just scroll through. There you go.
All right.
Go ahead.
Hi, I'm Marissa Weiner, and I'm pitching to buy Nuance Communications Incorporated and sell Amazon. And the returns will go up. Kidding? Okay, Nuance is a voice and language solutions, provides voice and language solutions for businesses and consumers. It's split up into 4 major segments. The healthcare segment is the largest segment, and that provides healthcare information management and also client documentation services. Then the mobile and consumer segment provides speech to text services for consumers, people with disabilities, and people who are driving to send emails and stuff like that. Enterprise is basically just information management solutions, and imaging is their smallest segment, but has experienced the most growth, and that provides document conversion services and whatnot. It is a largely growing international presence. As you can see, it's 29% international sales, and it's been growing. They have a long-term investment in R&D, and they have a lot of acquisitions. They're acquisition-based growth. They've most recently acquired Veroli, which is a part of their initiative to kind of acquire cloud-based solutions for their consumers. Okay, so here are the potential growth opportunities. So the first one is R&D. Recently, Nuance has acquired a few companies that have really increased its investment in R&D. It still has a kind of a low R&D to sales ratio in comparison to the rest of the industry, but that shows potential for growth. As they continue their acquisitions, that's how they're going to fuel their growth. Their imaging sector of the business is they provide the best imaging solutions in the entire industry. And it's also the smallest, but it has experienced the most growth over the past 3 years. So this has a lot of potential to further expand, especially with the healthcare reform, which I'm getting into later as well. In terms of acquisitions, it is an acquisition-based company. That's where a lot of the revenues come from and how the revenues are expanded. It is qualified with the fact that they have to deal with, after the acquisitions happen, kind of controlling those expenses and all of the expenses that come with the acquisition. However, a lot of revenue has been increased by that, and also they are mostly horizontal integration, so they are acquiring companies that will really increase their sales in each of their business categories. Their international exposure is increasing. They have products in over 80 languages, and so that's somewhat distinguishes them from their competitors, because most of their competitors don't really have that as much of an international exposure as they do. Finally, the healthcare reform is the most potential for growth out of everything else. The healthcare reform is causing hospitals and places that would use the healthcare solutions that Nuance provides in order to cut costs, and so that shows they will use like the client documentation systems in order to comply with the new regulations that are being put out, and so they're definitely going to have to purchase that in the future, and Nuance's products are the best in the industry. Okay, the risk to the potential growth is that the company does have high levels of debt in comparison to its peers, but not in the industry, so that is kind of a double-edged sword. The larger competitors coming into the market, Google and Microsoft have done some speech-to-text processes, but they haven't really come out with a similar products as Nuance has. So the threat of that is definitely something that needs to be considered. Also, the foreign exposure. It's good to have some exposure to the foreign markets, but the foreign exchange risk is obviously an issue. Also, the acquisitions. A lot of the problem with Nuance so far is that some of it, especially in the recent years, it's kind of been unable to be profitable because of the expenses of the acquisitions and expanding to the cloud system. So if they're unable to kind of contain those expenses and also work through that and contain that, then that's going to be a risk as well. So here's my investment thesis. So this is all about timing. They've experienced losses and expenses from all of their acquisitions in the past few years, and the price is really low at 16. It's at, I think it's at near the 52-week low. So the timing is right in order to buy it, and there's a lot of promise for growth because of the brand name of the company. Also, their diverse set of products and services. They have a kind of exposure to many different categories, business categories like healthcare, and also the retail individual consumer, and then also the larger businesses and the individual consumer. So there's a widespread diversity, and also some of their products are based not on different revenue cycles, like healthcare is obviously a different revenue cycle than consumer products, and also people with disabilities use a lot of the mobile and consumer solutions, so that's something that the demand kind of doesn't change for that as much as it would for like a seasonal demand product. Also, the losses due to the acquisitions, as I touched on before, are primarily in 2013 and 2012, and will continue a little bit estimated in 2014, but the losses are going to be a lot less considerably. So this is a good time to kind of capitalize when the price is low. They have a large amount of cash and increasing accounts receivable over the years, which shows that the acquisitions have been profitable and will continue to show that growth. They're increasing ROE and ROA. The PE is lower than the competitors in the industry, so this is a good time to buy. They are ranked highly in all of their products, or at least most of them. The analyst target price is $21.83, and that's a lot higher than what it is at 16 right now. So I kind of went through this. My overall grade is a B+, and I'm going to go on to my sell because I'm going to run out of time. Amazon is an online retailer, and this is my proposal to sell. The kind of motto is low prices and convenient shopping experience. There are 3 business segments: the online retail, which is the buying and selling, and also somewhat similar to eBay, the retailers will actually go and sell their products online. Also, the internet services, they have a cloud-based solution as well, and then the Kindle ecosystem is the Kindle and also all of the products that go with the Kindle, and the revenues are increasing. However, my sell thesis, so this company is very much overvalued. Its PE ratio is up to 1,300 times per earnings, and you can kind of see the comparison with Apple and how far it's gone, and that's only 2012, it's only up to 200, so it goes way up. Also, the revenues versus net incomes. The revenues are increasing steadily, as we see, and as the earnings will kind of tell you, but the net income is very flat and decreasing. It's because of the costs of the Kindle-based system and also the cloud system. So their profit margins are kind of suffering from that. So that's a big part of my thesis. Also in the current portfolio, there's a lot of tech, there's exposure to a lot of internet stocks in addition to retail, and so you're kind of being able to play that seasonality that you would get from owning a stock in Amazon and also the internet-based part of it. So it's really not doing much good, and we've made considerable gains on it. Also, lately insider trading has been happening. Eight people in the last 30 days have sold their positions in Amazon, and 6 of those 8 sold over 10%. So that's probably notable to add. The inflexibility of prices with online retailing makes it difficult because they want to provide that convenience to consumers. It makes it difficult for them to adjust prices and kind of increase their profit margins. So that's something that needs to be considered as well. Also, the prices are at an all-time high, and the forward PE ratio is a lot lower, obviously, than 1,300. So I think it would be a great time to buy or sell. Okay, some of the risks about this would be if the stock continues to grow, the momentum, and also if they start to be able to control the profit margins and expenses that they've incurred in the cloud-based system and also the Kindle services, because they're operating at a loss in the Kindle services when they sell the products. Okay, so then going through this, the business is really good, a lot of earnings and a lot of revenue, but the structure of having to keep prices low as an online retailer is kind of hard for them to do. The management is great, but there has been some insider trading, which is kind of, that's why I gave it a B-. In the balance sheet, there's a growing accounts receivable, which is great, but it has been, the growth has been decreasing. So the growth of the revenues and the growth of the accounts receivable has been decreasing from previous years. And so that the stock price is highly dependent upon the growth of the revenues because it's an online retailer. So that's also a signal that we should probably sell it. The PE ratio, well, it changed, I just checked today, but is 1,300 now, and so the forward PE is also a lot lower, so that's another reason why we should sell. And conclusion is just all of the things that I've said. And I have 17 seconds, so I guess I can say them again. Nuance is undervalued. It's a low price, even though the company has been suffering losses. In the long run, it's going to be profitable. The acquisition costs and all the R&D costs are going to be finished throughout this year. And the healthcare reform and imaging show promising growth. So who has questions? Yes?
Can you explain why Nuance, you graded their management balance sheet as like a B to B minus?
Sorry.
What industry Nuance is in? Like, is it tech or
So
healthcare?
Nuance is kind of, is in tech, but it definitely has a lot of other kind of exposure. So I think that comparing like the tech industry to its ratios is probably not the best comparison because it has like the exposure to healthcare and internet, which is like very different. I'd say that the management is a B- because, what was I say, B or B-? A B- because there's a lot of managers and it's a very widespread, and even if you look on their website, it's just really lists them. It doesn't really show a hierarchy, and I think that it could be confusing when managing kind of a firm like this. It needs to be a little bit centralized, especially when they need to kind of have all these acquisitions and organize the expenses of that. All right, that's it.
Carl Icahn owns 17%.
Yeah, he increased his position
He's a
in.
well-known activist investor. What are his plans for the business? Why does he own it? What does he say?
Well, he sees promising growth in the business, and he thinks that it's going to increase because of its promise or its brand name, and so how it's been great in the industry, and also the healthcare regulations.
Is he kicked out management? What is he trying to do with the company then?
I think he's trying to just increase. Well, he wants to get the consumers more interested in it, and also, I think kickstart management.
How how does healthcare reform affect this company?
Okay, well, the healthcare industry is obviously going through regulations that are increasing expenses for hospitals and people who utilize the healthcare information management techniques or technology, and also the client documentation technology. So they're going to have to like make their expenses, cut down their costs, and having that standardization with the healthcare information management and also the client documentation. A lot of the hospitals will be unable to apply for refunds from Medicare and Medicaid if they don't have proper documentation of their doctor visits. So what the client documentation is that the doctor, when they like write down in your file like what's wrong with you and what they do during your consultation, instead of doing that, they just speak and then it goes into a text document. And so that's really useful for doctors and hospitals and the healthcare reform that's coming out.
Who are their competitors?
Their competitors, well, they have competitors within each of their segments kind of because they're different, but their big competitor that I compared it to is Adobe, and also Google and Microsoft.
Last question.
So, yeah, you mentioned like Amazon has a ridiculously high PE,
Mhm.
probably one of the highest in the S&P, which you'd think wouldn't be justified unless there were strong growth potential.
Right.
What do you think is going to be the biggest drag on growth?
Well, I think that it's kind of, it's not sustainable growth because of how high the revenue is increasing in comparison to the net income. I think that a lot of that if they don't maintain or if they don't be able to control their overhead costs and their expenses, then it's going to definitely start to show within investors, and then the price is going to go down.
Excellent. Thank you.
Should I just go forward?
Yep, just go forward.
Okay.
There you go.
Yeah.
You're on.
My name is Mike Troy, and I'm going to propose a buy recommendation for McDonald's and a sell recommendation for Baker Hughes. McDonald's is an industry leader in almost every country that it operates in, with the exception of China. It produces very stable cash flow, even in difficult economic times, in the form of rent and royalty payments from the tens of thousands of restaurants that it operates around the globe. And this is especially very important for important free cash flow for the company. It's almost like a stream of annuities with minimal capital needs. It also has significant bargaining power over its suppliers, a lot of whom owe their existence to McDonald's. So this means the company has access to very predictable and competitive prices. And finally, dividends. Their dividend yield and payout ratio is unparalleled in this industry, and this is what makes McDonald's such a great long-term investment. On the other hand, Baker Hughes, inefficient, high uncertainty as to how well they'll integrate the newly acquired company, BJ Services, to the pre-existing business model, and relatively weak patent portfolio. So McDonald's, founded in 1940, based in Oak Brook, Illinois. It franchise operates tens of thousands of restaurants in about 120 countries, and it offers a variety of foods and beverages. It has a wide economic moat, meaning that it does a pretty good job at keeping its competitors at bay for extended periods of time. And a lot of this is owed to a very strong global brand and an abundant advertising resources that allows the company to maintain this strong global brand. And like I mentioned, strong bargaining power over its suppliers. And it's also very productive. The average annual sales per franchise restaurant is about $2.6 million compared to the industry average of $1 million. It's also innovative. It continuously introduces a bunch of new products with higher margins. And the successful beverage initiative, McCafe, is an example of that. Besides that, it continuously renovates and upgrades to increase customer traffic. McDonald's scores highly on pricing. By the way, for all the charts I use, I compare the performance with other major competitors in the industry. For PE, for example, McDonald's is lowest among its major peers in the industry. And I also use EV to EBIT and EV to free cash flow. And in both instances, the data suggests that McDonald's may be underpriced. And for further analysis, I use a dividend discount or dividend growth model, which only seems appropriate for a company like McDonald's that pays handsome dividends. And what you have to keep in mind here is that the dividend growth rate that I use is 5%, which is very modest given the past 5 years of dividend growth rates. And I come up with a 9.34% implied upside. And for the sake of writing, I also use a discounted cash flow valuation, and I come up with $133.55 with an upside of 27%. The balance sheet looks pretty good overall, but there's one element of concern, which is the debt to equity ratio, which it's not the value in and of itself that's a concern, but it's been increasing steadily over the past 5 years. Besides that, the income statement looks stellar. The profit margin McDonald's profit margin is it's off the charts. It's much higher than all of its competitors in the industry, as you'll see in this chart. McDonald's operating margin, you can see it's the blue. It's at 31.33%, and the closest one after that is Yum Brands at 13.26%. And again, the profit margin of McDonald's is highest among its peers in the industry at about 20%. And the return on assets for McDonald's, unlike the other companies, whose return on assets are more volatile, McDonald's has been more steady over the years, and right now it's highest among its peers. And the payout ratio, this is perhaps the most important part of my investment thesis. This is the highest among its peers, and this is what makes, again, McDonald's a very attractive long-term investment. McDonald's management, it's pretty strong. The new CEO since 2012, Don Thompson, he's a pretty innovative guy. He's actually the one who introduced the McCafe initiative that was very successful. Despite continuously reinvesting a significant amount of capital to global expansion and renovation, the company continues to maintain strong profit margins, and managers have showed that they're committed to returning cash to shareholders, which is always great news. And the top management team holds a multiple of their salary base in the form of company stock, which aligns their interests with shareholders. It's probably great incentive for them to increase shareholder wealth. And this is just the chart for dividend yields, comparison of McDonald's, Yum Brands, and Starbucks. The risks that entail this are increasing rivalry among fast food restaurants, especially restaurants like Five Guys and In-N-Out, who have both posted strong growth recently. Volatile costs of food and just commodities in general is always a risk for restaurants like McDonald's. And tight credit markets are never good for potential growth. And I'll switch gears and go to the sell thesis for Baker Hughes. Baker Hughes is an oilfield services company based in Texas. It provides services, technology, products, and consulting to oil and natural gas firms worldwide in about 90 countries. Baker Hughes has a very narrow, if any, economic moat. Even though the industry has bright prospects because oil and gas are more difficult to extract, and firms like these have more pricing power in the long term, but Baker Hughes has major competitors who are just bigger and just more profitable. Recently, Baker Hughes has consistently lost high-profile contracts to its competitors, especially overseas. And it has a relatively weak patent portfolio, like I mentioned at the beginning. It's also very inefficient, despite cutting costs across the board by decreasing R&D budget and shifting jobs to cheaper plants. It's consistently posting low profit margins. And acquisition of the BG services, which should have been great for the company, isn't really showing much value as of yet, even after 3 years of the merger. So there must be something internally that's inefficient in the company. And this is just to illustrate how their operating margin has consistently been lower than its peers, despite cutting costs and despite the merger. For price, I use a DCF valuation here too, and it comes with a negative 24%, so 24% downside. And the PE ratio is higher than the industry average, as well as its own 5-year average. The balance sheet doesn't look too bad. The current ratio, even though it's been decreasing year over year over the past 5 years, I don't think it's at a level that's really alarming. The main problem, like I keep mentioning, is the profit margins. It's consistently low, regardless of what changes they make to the company and the policies. And this is a return on assets that just shows year over year they're just lagging behind its competitors. Management pay policy is similar to McDonald's. A lot of it is tied to performance-based, I guess, pay packages. But like I said, the acquisition of BJ Services, which should have filled the product gap and which should have kind of closed the gap between Baker Hughes and its competitors, it hasn't done that even after 3 years, and it doesn't help that the product hole that they filled up is oversupplied right now by 25%. The risks fall in natural gas and oil prices, risk for every company in this industry. Growth overseas is limited because a lot of the countries tend to give large projects to state-owned firms. And the transfer of knowledge and expertise, what I mean by this is when they work overseas, they usually hire local talent. And in an industry where such trade secrets, knowledge, and technology is very sensitive, this could gradually shift to local firms, and this could be a problem for them in terms of increased competition. So I guess it's time for questions.
Q&A?
What do you think of McDonald's recent admission that it perhaps extended its menu too broadly in recent years? I know you spoke about the CEO's like new strategic vision and like.
Yeah. What did you say? Expand. You're talking about expansion, right?
Well, they basically said that like they offered too many new things on their menus, and that customers were not necessarily too turned on by those offerings.
Yeah, but then again, they're high profit margin products. The products that are actually feeding the company, its growth and all that, they're consistently bringing in revenue. So they're just trying new things. If it fails, it's not too easy to switch it out. The switching costs are almost not even there. So I don't think that should be a problem in the long term. I think right now what they're just trying to do is just test out new stuff because there's a lot of health concerns. They're trying to introduce a lot of like healthy, the wraps and stuff like that. So I think it should actually be viewed in a positive light because they're just trying stuff out.
How do you think Europe will open? Is there anything
That's a pretty good question. Europe has actually been Europe's been a drag on McDonald's recently because of their economy. But what McDonald's is planning actually is they're planning on opening about 1,000+ new franchise restaurants in emerging markets, emerging countries. So that should offset the loss in that part of the world if the economy doesn't improve. But if it does, I think it's great for them either way.
Last question.
Considering the fact that people are consuming more and more health conscious, what do you think about their health aspect?
I don't eat McDonald's because I know it's not, great for me. But there are the people who eat McDonald's. I'm pretty sure they're aware that McDonald's is it's a suboptimal, alternative for a proper meal in terms of nutrition. But people still go eat it. I think it's in the PowerPoint, very convenient locations, competitive prices, I mean, people are going to eat it no matter what. Like, I don't think it should be a problem for the foreseeable future.
I think you should emphasize their salads and other healthy alternatives
Right.
that they're introducing. Thank you very much. All right, CBS.
I'm not presenting today.
Oh, you're not?
Yeah, I think just switched up the last time we're going.
Oh, sorry.
My slides are fine.
Shoot.
Already, so.
All right, my bad.
Yeah, you put my.
Yeah, or it's right there. Just got file and yeah. Okay. Nice.
Does this work?
Yeah. Well, I mean, I'm not next, but.
We'll go.
Yeah.
Oh, I see. I didn't know. Okay.
My bad. Sorry about that.
How about that? Next week, yeah, right? I don't think, did you get a, what was it called?
That's fine. I'll.
Okay.
The clicker up there.
Yeah. All right. Good afternoon, everybody. My name is John Truscott, and I'm going to be explaining why we should be buying Lindsay Corporation and then selling Orange from our portfolio. All right, just an overview. I'm going to be talking about company industry overview and the BP analysis for both companies, and then we'll have the Q&A at the end. So Lindsay Corporation, what do? They sell mechanized irrigation systems for farmland. Mechanized irrigation is technologically more advanced, and the net effect is that it's more water efficient and provides higher crop yield than traditional irrigation systems. Additionally, they have a road barrier infrastructure business, which is small, only 10% of their revenues. So now a little bit more about mechanized irrigation industry overall. Right now, the market is in a global duopoly with Lindsay and its competitor Valmont Industries. Combined, they have 73% market share, and Lindsay has 30% of the global market share. This is because of the importance of a developed dealer network. If spare parts are needed, it's really important for farmers that get those parts as soon as possible because it's their livelihood at stake if something goes wrong. So that's prevented other companies from entering this field. Additionally, we have global trends that are increasing demand for mechanized irrigation. One is a shortage of clean water to use for agriculture, and also increased protein consumption and global population growth. Those last two both drive demand for crops overall, which will then drive demand for this kind of irrigation system. We actually already see this in action in the United States. In '98, 35% of farmland was used mechanical irrigation, and then in 2008, 46% used mechanical irrigation. Where I see the really big growth opportunity is internationally. Only 2% of the international market uses mechanized irrigation, and so I think this is a really strong opportunity for Lindsay. So that was the industry overview. Where has that taken Lindsay financially over the past few years? So here's a snapshot of their revenues and then balance sheet. So two things I want to emphasize. Since fiscal year 2009, they've had really solid revenue and net income growth. They're also, looking at the balance sheet, they're a very liquid company, and something to emphasize, look at debt in August 2013. They have zero outstanding interest-bearing debt, so they're very little leverage. They're a very liquid, safe balance sheet, which is a big benefit for them. So getting more specifically into the grades, I give business an A-. I think they have a really strong, superior product in an underpenetrated market. There's the global duopoly, as well as those catalysts that I talked about earlier for significant international growth. The only reason it's not an A is because of their infrastructure business. I haven't talked a lot about it because it's really small. It's only 10% of the revenues. The main problem with infrastructure is that it really derives from U.S. discretionary spending, which from all our the debt debates has really been a big issue these days, and really isn't I guess a safe way of generating revenue. So, but overall, I think the growth is really going to derive from its irrigation business. Now, for management, this is where Lindsay really separates itself from that other competitor in the duopoly. The other competitor was Valmont. Lindsay has a history of strategic acquisitions. All these acquisitions are aimed at enhancing its irrigation systems, making it more technologically efficient and making a better product offering. Something else I want to emphasize is its partnership with Syngenta. Syngenta, they produce water-efficient seeds and soil additives, and this partnership allows Lindsay to create a more holistic product offering for farmers, and it creates a competitive advantage within the duopoly because Valmine has no kind of partnership like this and has no product like this out there. So for the balance sheet, I want to emphasize again that absolutely no outstanding debt. So they're very liquid, very little leverage, basically no leverage, and it also provides them an opportunity in the future to actually issue debt so they can grow their international business, which I think is going to be a big opportunity for them. Additionally, I already talked about the revenue growth. I brought up the last 4 years because they were hit hard in fiscal year 09 because of the financial crisis, so we can see that they're really recovering very well from that. For price, I think they're undervalued right now, mainly because of what's going on in the short run with corn futures. Corn futures have dropped pretty steadily since like July because the market thinks there's going to be an oversupply. But I don't think this takes into account the long-term growth opportunities that Lindsay has, especially internationally, which I keep saying. So with that in mind, that makes it a great time to buy because their price is deflated. And given my projections, I think they're going to have a 5-year price appreciation of about 39%. All right, so on to the risks. Of course, the state of the agriculture industry and corn prices, if the profitability of farmers, that affects how much they're willing to invest in capital improvements like Lindsay's irrigation systems. Also, there's a tax reform that's coming up that could limit the amount of depreciation farmers can take off year one for capital expenditures. So that means there's going to be less tax incentive potentially for anybody buying, or for any farmers buying capital goods. And of course, the state of global economy. I keep emphasizing international growth, so of course, the global economy is going to be a risk for that. So just a summary why we should buy Lindsay. Significant international growth prospects. They're in part of a market duopoly, within which they have a competitive advantage. Strong balance sheet, short-term prices, or their prices deflated, and then of course the global drivers for demand. Now, I think we should be selling Orange from our portfolio. Orange is a French-based telecom company. They have a number of subsidiaries, including Dailymotion, which I thought was interesting when I found that out.
The video playing service?
Yeah, the video sharing service, yeah. So industry overview for French telecom, it's right now there's really harsh price competition in a really saturated market. They had a new market entrant that held really low price points, so everyone's trying to maintain their customers by lowering prices, especially in the mobile field, and that's really taken a toll on revenues. Additionally, recent regulatory changes, they've had to decrease the roaming fees they can charge, which is another hit in revenues. And they've also had to, there's also potential regulatory headwinds coming up, which include the removal of all roaming fees in Europe Telecom, and also the consolidation of the telecom market across the EU. Right now in Europe, you have to get a license for each individual country, so it's a very segmented market right now. And the telecom regulator is proposing to get rid of that, so it's one big market, and that's going to have a really significant increase in competition. In terms of the financials, something I want to emphasize is this average revenue per user in their mobile segment. You can see it's been steadily decreasing over the past few years, so we can see that this price war and also the decreased roaming fees are really taking a toll on Orange's profitability. So my self-thesis, I've already talked a lot about the industry, but some other things to emphasize for their business is they're not very much geographically diversified. 66% of their revenues come from France, Spain, and Poland, so they're going to have increased exposure to any kind of regulatory changes in Europe, as well as really increased exposure to the European economy overall, which I think is going to hurt them moving forward. Additionally, the French government owns a 27% stake. And the French government actually used this to block the sale of Dailymotion to Yahoo earlier this year, so that ownership stake is hindering Orange's business. Management, I give them a C. While they were able to develop their own cost mobile brand to compete with the price war, we saw from average revenue per user on the last slide that it's not really helping their bottom line. And also their CEO is charged with fraud, so that's never good news. For the balance sheet, they have high debt levels, and also because their revenue has been decreasing steadily, their credit rating actually was dropped back in April. In terms of price, given all their regulatory headwinds and just really the lack of opportunity, I think they're trading at an unsustainable PE right now. So I'm projecting, given my assumptions and projections, that's roughly a 25% price decrease in 5 years. Okay, so why we should buy Orange? They're struggling, or why we should sell Orange. They're struggling at a price war right now in a saturated market, and it's a poor economy in Europe. They have a number of regulatory headwinds that are really going to hurt their profitability in the future. And that government ownership, we've already seen through the blocking of sale of Daily Motion that it's hurt them. So I think that's going to be another drag on the efficiency of their business moving forward. And I think I'll be happy to answer any questions.
One
There's a
question.
lot of international opportunities for Italy, specifically what regions they're
So yeah, so I did leave that out specifically. So it's mostly South America and Europe, specifically Brazil and South America, and then Ukraine in Europe, which is already known for its agriculture.
Do you think that Lindsay would be better off spinning off its infrastructure business, perhaps?
Yeah, I think so. And actually, there's actually an article online already talking about that. But yeah, I think because it's not profitable, and also because it's such a small part of their business overall, I think it would definitely help them. And I think it's something they're actually considering.
Excellent, thank you. I hope everyone can stay for just a few more minutes. We're going to squeeze in the last presentation. There.
All right. Okay, so to start my presentation, I'm going to tell you guys why we should be long Transglobe Energy. To give you a background on what the company does, they're a P&E firm, production and exploration that is, and they trade on the New York Stock Exchange on the ticker TGA. They've got operations in Egypt and Yemen, and they're headquartered in Calgary. It's a relatively small company, as you can see from these sales volume numbers. They only produce they're aiming to produce about 21,000 barrels to 24,000 barrels this year, and that's off of about 17,000 barrels last year. So that gives you an idea that they're A, relatively small, and B, relatively quickly growing. To discuss some more about their fundamentals, just give you an idea of how these guys compare to other competitors. They've got operational expenses of $10.39 per barrel as of the second quarter of this year. And this other number, $10.31, is from 2009, and it was from the Energy Information Administration of the United States. So you could say that perhaps those expenses have decreased as Brent prices have decreased over the past couple of years, but I'm not entirely sure because I couldn't find more up-to-date numbers on that statistic. As far as the size of the company, again, talking about proved reserves, they've got about 15.6 million barrels of oil equivalent, and actually that's just oil. They don't talk about their gas reserves because they're basically negligible. So as far as the business overview goes, I think that they've got a pretty good industry they're in. I mean, Brent and oil in general enjoys relative ubiquity globally that few other industries do. And the company fundamentally has done well over the past couple of years, as we're about to talk about. Some reasons to buy the company. I think that starting with the Arab Spring in December of 2010, the company has sold off significantly and underperformed relative to its peers and the market in general. I've got a graph of that in the next slide or two. The valuation, I think that it's relatively inexpensive. It's 9.64. Lord knows that that's changed over the past couple of days, just as prices fluctuate. But that's a multiple that's associated more with companies that are large multinational oil companies like Total or ENI, for example. Not necessarily the small, relatively quick-growing, agile company that Transglobe is. Price to tangible book, I think that's a metric I like to use just to express whether or not it's cheap relative to its assets on its balance sheet. And while in absolute terms, I prefer, well, cheaper than 1.5, maybe like less than tangible book value, or maybe even less than like net worth capital. That's not the case here. That being said, competitors are priced closer to like 7 times price to tangible book. The strong fundamental business that I was talking about, you can see in the numbers for the top line growth, bottom line growth, and free cash flow. Free cash flow and bottom line have grown at like annualized rates of 40% over the past 4 years, which is very quick growth. And also, balance sheet developments have been relatively favorable in recent months. Long-term debt has been decreasing because of that company's ability to generate free cash flows. I think that which helps the business prospects in the long term, obviously. Catalysts, I'll get into more detail about in a bit. Just talking about that valuation I was saying. So TGA is this blue guy at the bottom that is down since last November. And if you recall, last November was like the president was elected and things basically sold off. I like to think of that as something of a low point in the last year. And since then, it's only decreased further. I think this is unjustifiable in the context of a business that has a healthy balance sheet, several catalysts that are going to help it grow, and fundamentally strong performance. The GDP is just a company that I think is not similar in the area that it produces, but it's an E&P company that operates in the United States. It's a similar size in shares of, in terms of market cap, and yeah, you've seen this thing outperform wildly, despite the fact that it makes 2/3 of the revenue. It hasn't been profitable at any point in the last 4 years. It's got tons of debt and it doesn't generate any free cash flow, yet it's increased from like $8 to $28, and now it's back down around $20. It doesn't really make sense to me. So potential risks are, since it does operate primarily in Egypt, the political situation in Egypt obviously poses challenges to this company. That being said, I think that going forward, that will be less of a problem, but I can discuss that in a bit. A slowdown in growth. One thing that we have seen this year, actually, they said that they're targeting $21,000 to $24,000 or barrels of production a day, but the figures have actually been closer to about 18,000 or 18,500, largely as a product of the approval process for new concessions being slowed down in Egypt. So I think this year we'll see slower growth, but in the future we'll see improved growth. Obviously, that's because the government has been in a questionable state over the past several months, starting back in May. With slowing growth this year, you may see costs continue to rise, but that hasn't necessarily been the case. Margins have stayed largely the same. Other external factors are what we've been talking about all class. Monetary policy globally has been very accommodative, and we can't necessarily expect that to continue indefinitely. And then fiscal policy obviously is going to cause markets to do unpredictable things. I mean, government shutdowns happening left and right, and we've kicked the can down to what, January this time? So who knows what that might do. So as far as the margin of safety goes, I think it does have a pretty healthy margin of safety. I'm not sure what the price is today. I think it's somewhere in the neighborhood of about $8.60 something. I estimated value closer to 13, 14, 15 bucks. So there should be pretty substantial upside if that is materialized. Things that are going to help that come about to fruition are the fact that the company is small, so it does have the ability to grow and scale up its operations as it has in the past 4 years. I think we can expect that to happen in fiscal year 2014 and to the future. Another thing that I can't continue to expound upon is the fact that its operations have been fundamentally sound for the past several years, despite the fact that there have been political concerns in Egypt. Its operations have not been hampered by those problems, really, and this is really the first year where you've seen any sort of material slowdown in growth. Management's even acknowledged in as recently as May, when the government was ousted, essentially, there were no material impacts to the company's staff, offices, operations related to that, those problems. As far as new growth opportunities, the government in Egypt has recently approved concessions for the company that will amount to thousands and thousands of more barrels of production per day, and they're in a they're geographically close to their existing concessions, so those represent tremendous opportunities. Also in Yemen, they've got very little going on right now, and in the future I think we can expect to see big things out of Yemen for the company. Also, because of the fact that management hasn't been able to expand like it wanted to this year, they've essentially got more capital than they can deploy effectively for this year, so they've considered repurchase program next year or implementing a dividend. The company that I think we should sell is a company called Acadia Pharmaceuticals. Basically what this company does is they're a discovery company for new drugs. What that means is that they try to develop new drugs in the hopes of selling them in the future. Now, you'll notice I say hope to because as it stands, they haven't actually ever sold a drug, and their prospects of doing so are non-existent for at least another couple of years. And my third point for why we should sell this is because of that, I don't even think this company meets the portfolio's guidelines. Basically, it could be characterized fairly as a monoproduct biotechnology company, and we can't have those. So to discuss the company's fundamentals, basically doesn't generate any revenues from drug sales because it hasn't ever sold a drug. So the way it does create revenues is from collaboration agreements, grants, and milestone payments. So like as their drug candidate progresses through trials, they'll receive payments. And another point to consider is the fact that basically the company's valuation is predicated on the success of this pimavanserin program. And so it's not entirely justifiable. They style it as a first-in-class treatment for for psychosis caused by Parkinson's disease, but that's not really true because essentially it's a treatment for psychosis. And I mean, even if you go on Parkinson's website, like I represent or suggest here, you'll see that there are plenty of other treatments already acknowledged for this condition, like clozapine, olanzapine, so on and so forth. They're essentially psychosis treatment medications. This one theoretically just be tailored more for patients with Parkinson's disease, but again, that doesn't really give them a niche because their niche they're talking about doesn't exist. Even if it did exist, the average time to market, as this is a figure from Tufts, has decreased dramatically from about 50 or 60 years ago to only 1.3 years as of the 1990s, and I can only guess that this figure has continued to decrease. These are just some other items on their income statement, balance sheet, cash flow statement. Basically, they finance themselves largely through equity, and they don't actually generate cash, so it creates this favorable position like they don't have debt, but that's not really the case. The company's been subject to significant buying recently.
Questions?
And questions? Go ahead.
So you said they went up 900% over the past year, is that correct?
Since last November.
Since last November. So is that all results of that one drug that can potentially?
Basically, as it works, that drug has been candidate for treating psychosis related to Parkinson's, and then they've also got it in trial for other disorders. Because essentially what psychosis is, like someone who suffers from psychosis is said to be psychotic. So it's essentially a treatment for this condition. As it stands, like for Parkinson's, it's in the third phase of trials, but for other conditions like bipolar disorder, I think, it's in the second phase. That being considered, you can't really say that this company is going to succeed. There are tons of examples of companies that have made it further along in the phase, the trial process, without having the actual success of the drug.
Last question.
So you mentioned that most of the Transload's operations are in the Middle East. Do they have the capacity to make a play on the U.S. energy revolution? And if so, what do you think the impact is going to be?
I don't think they would. I think they've established themselves as a company with a niche in Egypt, and for foreign companies, that's a relatively difficult niche to establish. If you look at other oil companies in Egypt, they're either they're basically domestic companies. I don't think it would make much sense for them to migrate to the United States to take advantage of activity that is largely already passing by. Like, I think if they wanted to, the time to do that would have been about 6 or 7 years ago, and indeed that didn't happen.
Correct me if I'm wrong, Transload is an Egyptian company?
It is
U.S. company?
a Canadian company with operations in Egypt and Yemen.
But I just don't think we're in Texas.
No, headquartered in Calgary.
Where?
Calgary. Questions? No? Okay.
Excellent, thank you very much. All right, so I will collect so number 4 is not CVS, Best Buy, it's Lindsay and Orange. I'll collect the voting sheets here. You can and probably should vote for yourself.
Should we put our names on it?
No, you don't have to.
I think I got a voting sheet.
And then I'm going to sit here and count them up. If you want to stay or not, I'll email the results out. One voting sheet. Yeah. Everyone who is traveling, have a safe and happy Thanksgiving. See you guys on the 4th. We'll finish up the pitches. And be thinking of other companies in the portfolio that you may want to sell if they're not being recommended to be sold. No. Any others?
Potomac River Capital. I liked it.
Smart guy. They've been quite successful.